I think there is a fundamental misunderstanding or an underestimation as to what these tariffs might mean. And what we're going to hear today from a lot of people is they're going to say, oh, $200 billion worth of goods at a 10% tariff, it's $20 billion. What's the big deal? We're a $17 trillion economy. What's it really matter? I think what that analysis fundamentally misses is that trade is not binary, right? Our supply chains are so interwoven, they're so interconnected that the law of unintended consequences is what's going to matter here. And I think what the tariffs are going to do is end up driving inflationary pressures higher. And we're seeing it, you heard it in a review of the headlines from last night, but even going back over the last couple quarters or two, what you're hearing from companies is they're talking more and more about input price pressure. They're not necessarily mentioning tariffs directly, but they're one and the same issue, because if you're going to restrict any amount of goods, you're going to push prices higher. I think the big risk is that when we get through to the other side of this, we're going to look back on tariffs and say, this was the inflationary catalyst.
And the reason that matters is because the Fed watches those numbers, and that's what they raise rates based on. And to this point, they've been raising rates based on a very strong economy. Mm-hmm. If they are raising rates because of inflationary pressures, then you worry that puts a halt on the economy, or?
Yeah, I mean, that's a stagflationary environment. There are good forms of inflation, right, because of growth, because of higher wages, things like that. But then there's bad forms of inflation, which would be like oil price pressures or, tariffs and things like that. And, I think if you think about this tariffs as opposed to just this binary thing like, hey, you're going to charge a rate here, you're going to charge a rate there. If you think about it, it's more like chess. Mm-hmm. The opening move of chess, there might be, call it 400 possibilities. The second turn, you're up to over 70,000. The third turn of chess, you're up over to like 9 million possibilities. And given how our supply chains are so interconnected out there, I think this is much more like a game of chess than anybody out there is willing to acknowledge.
Kathryn, you playing chess? What do you think?
That's a great analogy, the playing of chess. Look, I'll take the opposite side of that argument, because I do think there's a lot in the media about how this is going to derail the U.S. economy. In fact, it's less of a direct impact on the economy than on inflation. I'll agree with that point. And I'll also agree that inflation is the biggest threat to this rally. But if you do a quick back-of-the-envelope calculation here, we have China, 19% of U.S. imports. Imports are 17% of U.S. consumption. $250 billion is half of Chinese shipments to the U.S. A 10% increase in prices is a difference in CPI in tariffs, a difference in CPI if it impacted the entire import basket of about 0.16 points. So, yeah, I mean, if this were entire package were to go through, which it could or it could not, it may be a negotiating tactic, which is what I tend to believe. Were it to go through, we would see an uptick in inflation. Would it cause the Fed to jack up rates? I think that the Fed is reluctant to do so, especially with a flattening and potentially inverted yield curve. So I think this is a Fed that is going to take its time and watch and see how things play out. But I will contend that I think a lot of this, and history has set a precedent, is a negotiating tactic to get some progress made on tariffs and a freer and fairer trade scenario.
So let's just take that on its face and what are you laughing about,
Nothing.
Joe?
Nothing. It's her fault. It's
what
her.
happened?
Nothing. We'll talk about it.
I missed the joke. But
that's not fair. No.
I don't know what's going on. But
I missed it too.
We all
I will tell you after, I promise. It's nothing related to this.
With anything. And we're human.
We'll learn about it afterwards. Let me ask you this on China, though. Who do you think has more ability to win this battle, at least in the short term?
I think the U.S. has the ability to manage this better than China does. I think China has much more at stake. And what China really has at stake is they've got this massive population of people, 400 million people that are earning sort of like middle income, right? And if you think about a country, any developing country out there, it's relatively easy to go from low income to middle income, but really hard to make the jump from middle to high income. Right, so China put 400 million people into middle income through low-cost manufacturing, but to take the next step, they need technology, they need innovation, They basically need all the things they're working on right now. And if you look at the heart of what these tariffs are looking to do or are aimed at, they're basically telling China to slow down your innovation.
Right. Final question for both Kathryn and Joe. Is there a proxy for this battle that we should be looking at? Yesterday, somebody said Apple is the proxy. If there's one stock to look at on a daily basis that's going to be impacted, it'd be Apple. I'm not so sure it's Apple.
I would not agree with that either. I mean, if you look at the first round of tariffs, it was like, it was like nuclear reactors, offset printing presses, and like retreaded tires. Now, maybe the nuclear reactor industry just doesn't have a very good lobby, so they couldn't get themselves exempted from that. I don't know if there is one particular good proxy out there. I think it's going to come down to, whatever industries or companies have the best lobby group, they get themselves taken off the lists. So I think it's going to be hard to point a finger at any one particular company or industry. I would just say in general, look for references to input prices or inflationary pressure, and we're seeing that coming through in the Beige Book.
Kathryn, is there a proxy? Is there something you look at now on a daily basis throughout this battle?
I think it's emerging markets. Emerging markets are now in correction territory. They've been really beaten up, especially in the currency segment, especially with the yuan depreciating as much as we've seen it. So EM currencies are definitely a place to look. We've seen a recovery in recent days. I am recommending actively long positioning in emerging markets in equity and in fixed income. I think the valuations are very attractive, and especially for a longer-term institutional or retail investors, it's a good place to be.